Okay, it's the start of the month and therefore time to plug my Patreon service. So, if I could just take a couple of minutes of your time to explain the benefits. There are free tiers available. You can follow the link in the description box of this video and any of my videos on YouTube to come over and have a read for yourself. I won't read it to you. If you were to join the top tier, tier 3 for £15 a month, you would unlock all of the 162 exclusive posts which have been posted since the Patreon began. Most recently were my top dividend stock picks for the month of November. This is a video going into detail, it's over an hour long, looking at the stock rating system which is issued each month and the dividend calendar which is issued each month, and then I go through the ones that I'm most interested in based on company health, yield and a series of other factors. And then here's the actual dividend calendar. You can download 2 PDF files here. We've got a recent live stream and we've got a recent addition to the Elliott wave theory playlist as well, looking at channels. I mean, if we come over to that now, this has now become a bit of an epic series. It's now 14 videos long and it will basically teach you Elliott wave from scratch. You'll have a pretty solid understanding of it by the time you've gone through all of these. I'm always adding to it. We also have several other playlists as well, looking at trading, basic technical analysis, how to use TradingView, some deep dives and other things like that. So thank you very much for listening. Please consider signing up. We'd be very glad to have you. And yeah, let's get back to the video. Cheers guys. Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, it's time for a look at the SPY, which is our proxy for the S&P 500, a look at the VIX and the PCC as well. And we're going to be going over our Elliott wave counts and some classical analysis as well. So let's start by mentioning the expected 75 basis point hike which came in yesterday is no surprise, and the market's rather bearish response to the press conference and the words of Jerome Powell afterwards. Now, we all know the why something happens. We can all tell ourselves that. We've got so many fundamental reasons regarding economic policy at the moment, monetary policy at the moment, as to why things are happening. But the technical nature of, well, technical analysis, classical analysis and Elliott wave is based on technicals, and the where something happens on the chart, I believe, is always a technical factor. So let me show you what I mean by that. Let's just get rid of this for the moment and let's have a look at this little sell-off and where we came to. So first of all, let's have a look at resistance. So a level at 390, horizontal resistance, previous high, previous support, previous support, previous support, previous highs, la-di-da-di-da, projected in forward in time 390 spot 38. This is where we were going to sell off. Okay, and this is where we've sold off. Okay, unsurprisingly. We've come back into supply. If we were to take a fixed range volume profile, we probably won't have our point of control there, but we will have a node of volume there. Okay, so we've got these little voids here. And what do you notice? The second we come into this resistance level, this is where we've got all of this trading volume in the volume profile. We've come down to a level which was prior support, we've found buyers, we've rallied back into resistance and we've found sellers. This is supply. Okay, so we've come into a supply zone here and we've sold off. Now that's horizontal resistance and supply, but let's have a look at the Fibonacci retracement from this high, and you won't be surprised to find that it is exactly a 50% retracement to the tick. Here it is. So like I said, I'm not being, like trying to be facetious. I'm just pointing out we all know why it sold off, because someone's words fell out of someone's face. But the where something happens, that's a technical thing, and I'm always what should I say? I always like to see that confirmed on the charts, and that's what we've seen here. We've seen an established resistance level, we've seen a 50% retracement back into supply, and no doubt the market just needed a catalyst to sell off, and those words falling out of that man's face was all we needed. That's why something happens. This is where something happens. And you might be saying, well, yes, I know that, Tom. I've been following technical analysis for a reason. I know, and if you're one of those people, I appreciate your support and I appreciate your interest in the topic. Unfortunately, at times like this, there is more and more of a narrative coming out, which is TA's rubbish, it doesn't do anything, it doesn't mean anything, and the market will just do this because A, B and C. and it just gets a little frustrating sometimes because that's not the case. Okay, so there you go. Even the most recent price action is technical. So we've spoken about that. So now let's come out to the bigger picture for a moment, do some classical analysis. Now, as I've been saying for weeks, we're in a downward trend, obviously, lower lows and lower highs. It'd be a little remiss of us to turn bullish until this trend changes and we get strong signs of a reversal. We do have a bullish count as an alternative, but the primary is still bearish as we continue to set lower lows and lower highs. So the question now for me is this a B wave rally in an ABC and is it done, or is it a larger correction to come before continuing lower? So if we look at what we've mapped prior, we've got these three wave swings, okay, these corrective elements, these connective elements between the zigzags, and as I pointed out, each zigzag's getting progressively bigger and worse as market sentiment degrades and the hope for a pivot disappears. So the question now is, with these connecting three wave moves that I highlighted, is this sufficient to be the next link? Now, if this is the last ABC, yes, you could argue that this is going to be a final big zigzag, which is bigger than this zigzag, which is bigger than this zigzag, and the correction is just expanding as it goes down. We have an extremely bearish interpretation of that as an alternate as well, which is an expanding leading diagonal into an A. That's like the most dire prediction we have. But what I'm suggesting is the possibility that this is just a five-way move into an A. We have a B and a C to come before we roll over, so we might not quite be done yet. So while this recent low remains intact, that's a possibility. The deeper we get towards that low, the less likely that's the case, until we finally break it and then that idea is invalid. So there we go. On the longer term time frame, we can see how we've pulled back into, we just touched this demand zone here, and that is supported by the weekly 250 exponential moving average, which we can see the green line here. We wicked down through it. We've only broken this 2 times before since the bottom of the GFC. Once was in 2011, and after that was 2020, which was the COVID crash here. We've now touched it again, and we've bounced from it back into the 20 exponential weekly moving average to find resistance here, back into that structural resistance and supply zone on the shorter time frame we were talking about. So 250 still below, we found support at 250, still below the 60, still below the 20, still below the 10. So overall still in a downward trend, right? And we have to, like I said, lean towards that until we see evidence to the contrary. We did not get the clearest of reversal signs. We got a bullish engulfing candle on the weekly and then a very strong follow through, but now we've had a very strong reversal and the week is yet to close. We've still got 2 days of trading left. Pre-market is trading lower at the moment. Now let's bring up some support and resistance levels. We can see structural support here from a previous high, and these lows and highs here, this high here, these lows here, these lows here, these lows here. This support level at 323 spot 32 I consider to be the strongest local support level we have. It's still a significant decline from where we are, but it would be sufficient to complete that final zigzag and get down here as an ABC in a larger triple zigzag correction. So that's where I'm expecting the most support. If we look at a Fibonacci retracement, we can see that the 50 and the 61.8 are bracketing this demand zone from, we can see these previous move up as buyers have come in and brought up, and then it brackets these 2 support zones as well. So somewhere in this box is still where I'm expecting the market to come down to, somewhere in here. Okay, now it's still a ways off. We don't have to, we could have bottomed, but I think we should probably look or expect further declines, and this area seems to be the strongest confluent area for support as well. If we bring up our FRVPs as well, we can see that in this area of demand, these 2 pullbacks which have found buyers, we have our point of control for the entire move up off of the March 2020 low, which is straight in this area here. As I said, it's bracketed between the 50 and 61.8 and 2 support zones. So there's a whole bunch of confluence down here. I'd be amazed if the market didn't find support down here. Okay, so that's basically the longer term picture. So now let's come down and have a look at the smaller time frame. Well, yeah, actually, no, just before we do that, let's just talk about the divergence we've seen on the RSI and on the MACD between these weekly closes here and these weekly closes here on the RSI. So we've had higher lows and lower lows in price, and it's led to this little rally. Now, a multiple month divergence from June through to October, to me, suggests a more significant rally than this. That's the one thing that's got me a little bit like, yeah, we could roll over and do that. But we've built up a really significant divergence over a few months, and to just have this one little pop, I mean, that just doesn't quite fit. I'm not saying it's not possible, I'm just saying, you know, that's why I think giving this the potential to be another free wave leg before rolling over. I don't know, maybe it's just my personal bias slightly creeping in there, which is I like to see things in both price and time fit my idea of what would be ideal, you know, and that's not always the case, I understand. So let's come down to the daily time frame here, shut off all this noise, and let's bring up the primary count. I'll come down to the 8 hour here, get rid of the moving averages. So this last move, if we go for the bearish count, which is our primary still, we can interpret this as a free wave move into a B. We've had 5 down in an A, WXY into a B. I think a double zigzag is the best fit, and now we're going to have that final 5 wave move down in the C into those support levels we saw in the larger time frame. Alternatively, we need to change the wave degree down to minute from minor and this down to minuet, and we're actually getting a free wave move like this, and that will be the B here, and then we will continue to move down lower. So we know we've done 50%, but let's say we want to do 61%, or let's say we want to do 78% for the B. Okay, we could be looking at something like that. A zigzag up to here for the B, could be the 61.8, could be the 78.60, is going to be here somewhere. Let's just check that for wave 2. Here's the 78.6, here's the 89. Okay, we don't know how deep this B is going to be. It's done enough at 50, so we could roll down from here, true. But time-wise, it just, to me, feels like it wants to hang in there for a bit longer, but I could be completely wrong. You know, I've seen resistance met, I've seen the 50 met, I've seen us come back into supply, and we've rolled over. So for the meantime, having rolled over, we should be expecting lower pricing. If we break that high at the 50 Fibonacci here, at that prior resistance, if we just bring up that local support level, so if we were to break 390, spot 38, I would be saying yes, we're going to continue into a higher B wave now, or we're bullish. If we stay below this level and continue to impulse lower, then we're going to make new lows. That's how I would look at it in the short term. Okay, so that's a bearish count. Now let's consider our bullish count that we looked at last week. Getting off of the low here, there's a couple of ways we can do it, I guess. I think only one of them is going to be legal now, to be absolutely honest with you. And let's see what I've got here. So I've got this as a leading diag. It's not a leading diag in terms of it having impulse waves rather than zigzags. Very odd that that seems to have become a trend in Elliott wave coverage lately. A lot of people seem to think that the leading diag is 53535. A leading diag is still primarily 33333. It just can be 53535, whereas an ending diag is always zigzags. So we're still more commonly going to see a series of zigzags in a leading diag than we are impulse waves. It's just one of those things that I've seen people incorrectly say that it has to be 5. It does not have to be 5 at all. It's still more likely to be 3s. Okay, and on that note, we have a very clear beginning of 3, I would argue, into the 1. We get a zigzag with a flat in the B wave, 535, and then this can either be subdivided as a 1, 2, very small 3, 4, 5 into A, B, and C, or we can have a very extended A, flat, and a small C. There's the only two ways I can see dividing that. We can't say this, as this would make the 3 longer than the 1 and it would no longer be a contracting pattern. At the moment, the wave 4 is smaller than the wave 2 and the wave 3 is smaller than the wave 1. So it's a perfect, well, it's not perfect in terms of how it looks, but it meets the rules of a leading diagonal. And then we have a zigzag into the 5th, which fails to throw over the trend line. More common in a leading diagonal, a contracting leading diagonal, but we get that throw over. Sorry, excuse me, revise that. More common that we get a throw over in a contracting leading diagonal pattern than we do in an expanding one, and it's actually more common to get a throw over in the ending diagonal, that is a contracting pattern, than it is in the leading. Why is that, you might ask? Because the first move off of a low tends to be quite tentative and uncertain. People are not like, wow, let's go, this is definitely the low in. However, at the other end, as we peak in a market into irrational exuberance and mass hysteria, then the likelihood of a blow off top is actually more likely, and therefore throwovers, I would argue, my own observation, a throw over is more common at the top of a pattern than it is at the start of a pattern, and it is definitely more common in a contracting pattern than it is in an expanding pattern. So there you go. We don't get it here though. So from here we can now expect a move back to the golden ratio, to the 50 and the 61.8, okay, or deeper, being a diagonal. Diagonals can often lead into very deep wave 2 retracements, so all the way down to the 78.6 and the 89. So this count is invalidated back at the start of it. So let's just add in our little invalidation point down here, like so. .348 spot 11. There we go. Throw this into the bullish folder. Save. So that's our invalidation point, 348 spot 11. We can come down here and we could be doing 3 waves A, B, C before collapsing, but this could also be a 1 into a 2 off into a 3, 4, 5 going higher, and we've bottomed. We just now need to wait and see whether this is a retracement or whether this comes down to make new lows. Alright, obviously in the meantime, the short side setup has been as we've seen, that divergence into the high, preparing to go short. First move down and back, that was the opportunity to short here. If we get 5 waves down on a larger time frame and then a retracement, that will be another opportunity to short, coming back into prior resistance, looking for a 50 to 61.8% retracement. First move down and back off of that, there's your entry, there's your stop, and off you go. So there's still opportunity to short if that's what you want, if you haven't got it in yet. You could take it now if you really wanted to, and take the previous high here at the top of the pattern as you stop. Bulls, you've got to wait now for a retracement to take a shape. Okay, if you believe that this is a 1, you're jumping in a little too early thinking this is a 2, in my opinion. So we want to see some kind of pattern down into a retracement. We want to see weakening momentum into that low. We want to see signs of reversal, and then we want to see the first move up and back to a higher low, so a high and a higher low, breaking the trend of lows, lower lows and lower highs, and there's your entry back to the long side to come. So you can play this either way. It could be either way. So that's how I see the count at the moment. At the end of the day, we've got a bullish option, which is it's done, WXYXZ. And we've got the longer option, which is this is just an A wave, and we've done a B and we've got a C to come down, which is the primary at the moment, staying bearish, thinking we're going to come back into that 50 to 61% retracement level, all of that support, all of that buying demand down here, and we'll find something down here to stop us. Okay, so that basically covers the SPY. There's one more thing to look at, which is a very bearish interpretation, which is the leading expanding diagonal idea. Okay, so this is truly quite diabolical. Zigzag into 1, zigzag into 2, zigzag into 3, zigzag into 4. And this will be zigzag into 5, falling short of the trend line in an expanding diagonal most likely, probably into this support zone. that we've been expecting, and that would, all of that would be A. You see why this is so negative? That's A. Then we get B over the next year or so, or 6 months to a year, and then we get C, taking us down to new lows again into the next year or so. This would be a massive cycle correction, and my longer term count for this being part of a super cycle wave 3 and cycle wave 5 would be completely wrong at that point. But I think by then, you know, you got much bigger long term problems. So anyway, that's the most bearish case. It's not the one I support. I prefer the idea that we're in a primary 2 and we've got some more correcting to do before we find a low. If the downward trend breaks, momentum returns positive, we take out that local resistance high and continue to march higher, then we can start to consider the bullish count more seriously. The macro fundamental picture does not seem to support the idea at all at the moment. And on that note, later this month, for my patrons, I'll be doing a video. I've covered it in live streams before, but I'll be doing a video on the macroeconomic leading indicators that I look at. You know, I look at a whole bunch of leading indicators across housing, manufacturing, inventory. I look at the ISM, I look at the PMI on manufacturing data, I look at housing building permits, I look at employment data, obviously, I look at consumer surveys. I do all that kind of stuff to try and get a feel of what the leading indicators are, which is still negative, still pointing down. Lagging indicators, which is what the Fed bases their policy off, CPI and employment, are still looking very strong, and therefore they keep smashing the economy with higher and higher rates. But sooner or later those things are going to change. So anyway, getting distracted. So there you go, that's the SPY, that's how I see things at the moment. Let's come in and have a look at the VIX. The VIX, quite surprisingly this morning, is still suppressed. It's back at the 250 daily average here, but it's not rallying. So the market is sold off in an extremely orderly fashion. There's been no, true panic or fear event. Now, I'm not saying it can't come. If we make new lows and then start to accelerate lower, we could see the VIX explode. But essentially, the plumbing of the financial system is still holding together. We haven't seen the breaking of something yet, which a lot of people were calling for. I myself am a little surprised that things have not broken somewhere yet. I think the number of backstops in place by the Fed to help protect the financial system since the last pivot in 2018 have gotten even larger in scope, and therefore the preparation and vigilance to avoid a financial disaster is greater than it's ever been. And maybe that's just keeping everybody's heads above water and keeping things stable at the moment, but there's always the potential for a black swan, and nobody understands or is prepared for to occur, and that could send the VIX screaming higher. But still suppressed. Even though the market has been selling off, it's still suppressed. PCC. So looking at my little index here of the PCC with my extreme fear and panic line and extreme greed and complacency line, ever since we made new lows during the extreme run up in the markets, we've been heading back towards that fear and panic territory here. I marked the PCC extreme that we got here on the 21st of June on the stock market, on the SPY, on the low. We rallied, but then we sold off to lower lows in October, where I've got this second lower high in the PCC. So there's divergence between the PCC and the lows in the stock market. So that's either a sign of an extended correction before another explosion higher, potentially taking out this long-term trend line that we've been playing with, right? And we finally have some kind of capitulation event, a complete breakdown in the market, and the PCC screams higher. But at the moment we've got lower highs. We have yet to move the 60 back below the 250. If I see that and the rally in the markets, this very much leans into the idea that the low in the stock market's in. So I know that's not the primary count at the moment, but this can lead and it can lag. It's not always perfect. I've spoken on previous videos about how some of these peaks in the PCC are days before and sometimes days after, sometimes weeks before, sometimes weeks after the actual lows that form in the market. So I just find it a little odd. Yes, we're still elevated. but we haven't got extreme volatility. We've got rising volatility over several years from 2006 to 17 onwards, but we just haven't got the kind of volatility one would expect with the major index selling off 30%. We've got the put the call ratio we'd expect to see, but that appears to have peaked as well. So we're still in limbo, guys. Primary count suggests lower, but the market is just trying to feel things out. Okay, I get the impression that if it was to lose hope and to give up on the idea of there ever being a pivot or a slowdown in rate rises, or to give up hope completely, then there could be a pretty nasty capitulation event and we would finally get our VIX explosion. But for the meantime, it's hanging in there. We have, for the moment, what could be a sustainable low, but it's still got a lot to prove. Alright then, I think we'll leave it there, guys. If you're new to the channel and you like what you're seeing, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. And as always, a huge thank you to my Patreon subscribers. If you're interested in joining the Patreon, there's a link in the description box below. Head over, have a read of the tiers, see if there's anything that interests you, and feel free to sign up. It is the start of a new month, so it's the perfect time to do it. I've just issued my dividend calendar and my stock rating system for November, plus a video illustrating my picks for the month for those of you out there who are more interested in investing than trading. And of course you get access to the Elliott Wave playlist and all the other technical analysis videos, as well as the public Discord. Also, if you're not following me on Twitter yet, there's a link in the description box below for that as well, where I always post new videos when I upload them to YouTube. So, take care of yourselves, guys, and I'll be back with you as soon as possible. All the best. Bye-bye.